Time. Thanks for being with us here. So let's talk about whether or not this market can be resilient enough in the face of that rising rate picture.
Well, Dom, I think what you're seeing is a rotation. Like the Dow was up, the NASDAQ was down today. And I think that that's going to continue over the next 3 to 6 months because I think rates are going to continue to rise. I think inflation, next Tuesday is a very important date. The CPI is coming out. It's the last CPI before the May meeting of the FOMC. And I think 50 basis points is in the bag. And honestly, if we get a bad reading next Tuesday, I know James Bullard will probably be calling for 75 basis points. So we have more hikes to look forward to. And that means more of that rotation towards the value stocks and away from those stocks with the cash flows far into the future.
So that growth story that you mentioned there, the ones with the cash flows far into the future, we did see in the last 15, 20 minutes of trading or so, a bit of an acceleration to the downside in some of those tech and growth-oriented names. Is this one, though, that you feel could provide that really deep pullback in the tech sector and the communications sector that a lot of folks have been calling on for months, if not years at this point, but has never really materially happened ex a pandemic back in March of 2020?
Well, I don't think we're going that low, but I think one could say that NASDAQ might test the lows that are reached at the end of January and early February. I think people got a little too excited about that rally that we had, that 2-week bounce, and said, oh, it's all over. But the rate rise is not all over. And I think that that's going to weigh on those stocks. That said, the market is holding in very well because people say, I want to hold real assets in an inflationary environment. And stocks are really claims on real assets. So I don't think overall the stock market is going to be damaged that much. But it's going to be a tough first half because the Fed, I think, is going to have to be even more aggressive than is indicated right now.
So if the recovery, Professor, since the great financial crisis back in 2008, 2009, didn't teach you something about this notion that you want to own stocks or real assets as things recover, the pandemic should have, right? And that was more recent, just in the last couple of years. Is there a case to be made, though, that this inflationary picture is perhaps not as much of a factor right now, given a very, very strong inflation narrative, the likes of which we haven't seen in 4 decades plus?
Yeah, that's true. Well, history says in the long run, stocks will take care of inflation. The returns will take care of inflation. As the inflation starts, actually, the stock market runs ahead as it did last year, beginning of this year. When the tightening gets serious, the stock market tends to flatten off. And then when they finally succeed, it'll take off again. So I think you're going to have that sort of an S shape in the market being tough as the Fed says, I'm going to have to get much more serious, and they're going to have to get more serious. I do not see a recession in the cards anytime soon. The market, the job market is just so strong. Maybe out in 2023, and it might be mild. I'm also not worried about inversion. I think we're in a world where the long rate is never going to get as high as it once was. We're going to see a much flatter term structure, and we're going to see many times when that short rate is going to be above the long rate, and that doesn't necessarily signal a recession.
So Professor, you perfectly kind of got me to this next part of my questioning, because what I'm curious about is a lot of traders and investors have told me that this particular rate hike regime is not like any other rate hike regime that we've seen since the advent of the central bank back in the early 1900s. There's been a lot of Fed intervention, central bank intervention overall. How much, though, is the interest rate picture and those yield curve differentials going to be indicative of what we've seen in the past in economic cycles, or is this time truly different, not to coin a cliche there?
Well, you're perfectly right, Dom. In fact, for 49 years, I taught macroeconomics and financial markets, and I taught that in an inverted term structure was the single best indicator of recession. But what we've seen in the last 2 or 3 years with the long-term rate being a favorite hedge of investors, and that's why it is so low relative to inflation, that I think we're going to see flatter term structures. I think we need maybe 1 to 200 basis points or maybe even more of inversion before I'm convinced that there's going to be a serious recession. So I'm not worried at all right now about the recession. I think there are a lot of demographic forces, risk aversion forces, reserve forces driving that demand on that long bond. It'll go up above 3, probably to 3.5, but we're not going to see the 5, the 6, the 7. And of course, I don't know how many of our listeners remember, I do, 40 years ago when the 10-year rate was 16%. We're not going back to anything like that.
I remember when my parents' professor told me about their mortgage rate back in the 1970s and the double-digit percentage numbers it was then.
18%,
All right,
1980.
Exactly, right? And so if you talk about this notion, and we've heard many people on our air, experts on our air, come up and talk about this idea of what's priced in, what's not priced into the market with regard to Fed moves here. At this point, aren't we all pretty clear that the Fed is going to raise rates and reduce the balance sheet? What would actually be a surprise in this kind of a news cycle?
Well, I think the market is looking now at, maybe 2.25, 2.5. Very honestly, we heard James Bullard, and I've interviewed him many times, and he says, I want to see it above 3. He's been right so far, being the most hawkish member. And I think if the data, I'm looking at a lot of this data, I don't see any relief from inflation soon, and the Fed is going to have to be more aggressive in this score. As far as the reduction of the balance sheet, very honestly, it's too slow. I know it's double the rate that it was 3 or 4 years ago, but the Fed, since the pandemic, has added $4 trillion to the balance sheet of the commercial banks, the Federal and the Federal Reserve. They're going to reduce it $100 billion a month. That's $1 trillion or a little more after a year. Well, by then, the Fed says the inflationary pressure should be subsiding, and they've only taken away a quarter of the extra balance sheet that they added over the last 2 years. So I really think they need to speed that up. Also, if they want to send a signal to the market, we're really serious about this inflation. These are the impediments that I think, the hurdles that the stock market is going to have to get over in the next 3 to 6 months. And that's why we're going to have volatility. And I think some certainly choppiness in the market with the rotation towards the value stocks.
So, Professor Siegel, I get it. You're adding your voice to this more hawkish narrative that's been permeating through the markets right now. Please